Good afternoon and welcome to Unlock the Stock. We are pleased to welcome Karooooo to this platform, and the CEO, Zach Callisto, will be taking you through the presentation shortly. This Unlock the Stock platform is specifically designed for retail investors to gain access to corporate management and to get to know them and their companies a little better. Unlock the Stock is only possible with our technology partner, Lumi Global. You can visit their website at lumiglobal.com to learn more about Lumi's various online AGM and investor presentation solutions. Our hosts, as always, are the Finance Ghost and Mark Tobin from Coffee Microcaps, and they'll be facilitating the Q&A session at the end of the presentation. This event, as you know by now, is sponsored by A2X, a stock exchange that plays an integral part in the progression of the South African financial markets. A2X is the second largest stock exchange in Africa as measured by market capitalization, with 183 securities listed on the platform, including 31 of the top 40 stocks, with a current combined market capitalization of 8.7 trillion rand. The team at A2X is proud to be partnering with Unlock the Stock. Just as we provide a platform that unlocks value through insights and analysis, A2X unlocks value for stocks listed on the platform, helping to drive markets forward. Before we start, there are just a few housekeeping notes to just be aware of. Zach will take you through a presentation that will be followed by a Q&A. Please note that you will be able to post your questions by typing them into the Q&A box, which is at the bottom of your screen. This event is being recorded and will be available on the Unlock the Stock YouTube channel. You'll also see an email address when we start the Q&A session, and if you'd like to be added to Karooooo's distribution list, please can you send an email to that address and they will put you on. Zach, we are ready for you to share your screen with us and take us through your presentation, please.
All right, so I'm not certain to what extent the audience is familiar with us or not familiar with us. So I'm gonna assume that the audience is largely unfamiliar with us, and I will be in a certain way cover as much as possible about the business in high level fashion. Anybody who's got further questions can always ask more particular questions either by email later or in the Q&A session. So currently, we started off in South Africa. We started trading in June 2004 as Cartrack, and approximately 2 years ago, we re-domiciled ourselves into to Singapore, given the large opportunity in Southeast Asia. And at that same time, we also we remained listed, well, we delisted off the JSE and then listed on NASDAQ and then relisted Karooooo onto the JSE. So today we listed both on the NASDAQ and on the JSE. What we did approximately 2 years ago, just under 2 years ago, we acquired the business, 70.1% of the business. It's Karooooo Logistics. The idea there is to integrate it into the bigger platform of Cartrack, which we're busy doing, and we should have that done within the next 12 months or so. And that business is something we bought that was quite small at the time, and it's growing exponentially. It's growing quite fast. We also started a while back a business called Karooooo, which was basically the trading of second-hand vehicles. The rationale there is a 10-year rationale where we would be involved in servicing our customers in distribution vehicles, and we also could add value to our customers in giving them better prices for their second-hand cars, because we got the visibility of those vehicles when they're getting sold. However, we've, for the last 12 months or so, we've had quite a lot of headwinds from the dealerships that give us support in South Africa, and they've been asking us to close it down, otherwise they're going to stop supporting us. We've been trying to convince them that we're not competitors of theirs, but I think at the end of the day, we weren't able to invest more in the business in hoping that we could resolve this, and at the end of the day, we conceded to actually close the business. So you will see by the end of the financial year that we won't be reporting on Karooooo. We estimate that the inventory that we have, it will all be sold. So, um, what we'll go is cover what we do for our customers. So we see ourselves very much as a company that we continue to evolve, we continue to improve our platform and to keep up with the times, and also given the technologies that are available, that continues to evolve. And with the given technologies that continue to evolve, we try and stay ahead of the pack in relation to our peers, and to make sure that we add real value to our customers with a real value proposition. The sort of things we help our customers with is compliance, and that's becoming bigger and bigger. We see that specifically becoming bigger in Europe and in Asia. I think South Africa is lagging behind on that, but I think South Africa will catch up, and one day will also be driving compliance on the roads through digital platforms. Workforce and asset management and optimization of those are the real winners for companies that we onboard. They really become much more efficient with both their workforce, and by workforce we mean not only drivers, but even people that are out doing sales or delivering goods or offloading goods. We help them optimize those costs and the productivity. And then, of course, very involved in the safety and well-being of drivers for companies, because we believe that is a driving force to be able to mitigate a lot of risk with unsafe driving, and with if the well-being of drivers and the training of drivers is not kept up to date, that also becomes quite a big risk for our customers. And then obviously something we've been doing for many years is the real-time visibility of vehicles, workforces, and sites. And that's obviously continues to develop. So our technology today has got a lot of AI, it's got a lot of machine learning, and AI really is just algorithms, to be honest. And a lot of people use the word AI loosely, but fundamentally, what is AI? It's just the amount of algorithms that you're using, and to the extent the machines and the capacity of machines and technology, they're able to process things much faster today than even 3 years ago. One of the reasons why we win is our platform is extremely easy to use. It derives really valuable information to our customers. And I think our value proposition is really the strong ROI that we have, that we give our customers. People often ask, what is the ROI? It's a very complex thing to actually determine what is exactly the ROI. But what we normally find is, the investment of the customer upfront is zero. It's the monthly fee. And the real benefits the customer really get is in the first, I would say, month, maybe a bit more in the second month, in the third month. And then the benefits are sort of just keeping all the benefits that they've had in the first 3 months going forward, and obviously with the continuously updating of our platform. And we believe the ROI runs clearly well over 1,000% for most customers. We also have, there's quite a big drive, not only by us, but even by our peers, with the video telematics, which that obviously drives a lot of driver safety. And it obviously also helps in accident, reconstruction of accidents. It also helps with the safety of the drivers and security of cargoes. So that is our real new drive of things, and that is really, we believe that's really a huge opportunity to build, and it's just another stack on top of our current platform. So all of these things, we also very privileged that the way we've built our business has really worked out, and that is we vertically integrated, and everything sits on one single platform, including even the way we run the business. Our internal systems are also one proprietary platform. In actual fact, our only third-party software is actually our accounting package. We have over 113,000 customers using our platform. Our largest customer has got 37,000 vehicles, and our smallest customer has got 1 vehicle. So we've got at this point in time, about 550,000 consumer customers. They're in South Africa, and we've got about 113,000 commercial customers. We are a very strong believer that the only way to build a business is actually with the talent. And I believe we've got a very strong culture at the business, and that strong culture drives our success and our innovation. And we certainly believe that culture is a very important part to any business. I will now go through our financial performance of Q2 FY24. I would imagine that most people on the call are familiar with this, so I will go through it as quickly as possible to give the audience more time to ask Q&A. Our subscription revenue was up 17%. We believe subscription revenue is the important part of the business. We believe revenue is not an important part of the business because most of the cash sales that we do, we're actually selling the hardware, not making profit. It's very little profit, and we are in the business of really having an annuity business and not a hardware business. We also do not sell hardware to any third parties, and we also make sure that all the customers that are using our technology, we own the customer. So the customer is not owned by a third party. And the third party could be a distributor in certain countries. It could be an OEM. It could be many third parties that own customers where we just the provider of the technology, and then they own the customer. I think that's very important. We have consistently always had a tremendous amount of cash generation. Cash generation was up to cash from operating activities was up 26%. Operating profit was up 13%, and earnings per share was up 14%. Our business model is clearly that because of the way IFRS works, is that your earnings and your subscription revenue, they might not align, given what you've expensed up front to gain customers, and those expenses, obviously disalign your income statement. But on our unit economics model, which is basically a different financial model that management uses to build a business, we have, our earnings per share is actually up more than this. We have a very efficient collections day, and we have very strict rules on keeping customers on our platform, and that allows us we've got a very healthy debtors day of 29. Like I've said previously, we've got a strong cash generative business, and our balance sheet is clean with no debt, and we had at the end of Q2 651 million rand in our balance sheet after paying just over 500 million rand as a dividend during Q2. We've got robust operating margins. So if you look at our operating margins, they're well above any of our peers, both in South Africa and abroad. And that gives us a lot of pricing power should the market become competitive in terms of pricing. Also, given our unleveraged balance sheet, it also allows us to easily to get cash to grow our business. At this point in time, we've got facilities of about 1 billion rand that are currently unused. We will use some during Q3, but fundamentally it's unused. Our earnings per share growth, there's a very strong correlation to our subscription revenue growth, and that continues to grow. If you look at our earnings per share, we had a record in Q2 of 5.89 for Cartrack. For Karooooo, that was a negative of 42 cents. That will disappear by FY25. well, if it doesn't disappear in totality, it will be insignificant should we have any inventory vehicles at that point in time. But we intend providing for that during this financial year if for any reason at Q4 we still have any inventory. Karooooo Logistics, that's a business that we bought approximately 2 years ago, and that is starting to contribute to our earnings per share. If we look at slide on page 14, that shows you historically how we've continuously grown subscribers. And it's very important that a subscriber is a vehicle. Some vehicles might have 2 or 3 devices in it. So we do not count devices, we count vehicles. Our subscription revenue it continues to go up every single quarter. It's gone up, and our operating profit, we had a record operating profit in Q2 of 252 million rand. We've also proven that our ability to scale the business in very, very macroeconomic conditions, even during COVID and during recessions and difficult times, we've continued to grow our business. And we've consistently beaten the rule of 40, which is a rule largely used to measure software companies. So our number of subscribers, it was a record in Q2. We did 75,000, which was more, 31% more than in FY23 Q2. So, and in Q3, we're also having a record. So we expect that in Q3, we should beat last year's 78,000 vehicles. Additional, so by the way, these are net subscriber additions. These are not gross. So this is after the churn. This is what we're adding. We've got a decade plus track record of growth. So subscription revenue up 17%, revenue was up by 17%, ARR was up by 17%, operating profit 13%, adjusted EBITDA 9%, and subscriber growth up 31%. Well, that's the net subscriber additions. That actually needs an edit. Sorry, I've picked up an error here. And I think what's also very important to us is that we are a annuity business, and 97% of the revenue is actually subscription revenue. Like I said earlier, it's critical for us to evaluate our business based on unit economics. And on our unit economics, it's what does it cost us to put a vehicle onto our platform? And when we talk about a vehicle, it might not be a vehicle. It could actually be a forklift. It could be a yellow machine. We just call it, or we're using the word subscriber vehicle, but it's actually any equipment that we actually assisting businesses in managing, or individual customers that we assisting them with risk mitigation, whether it's vehicle theft or accidents, or roadside assistance, whatever we do for individual customers. So we've been quite consistent between FY21 to FY22, FY23. We've sort of been between 2,100 Rand and 2,300. Things change, the exchange rates have an effect on that, the cost of technology, the cost of marketing, the inflation in salaries, all of these things have an effect on that. But I think we're extremely efficient at managing these costs, and we do it, I believe, really well. So it's cost us approximately 2,300 Rand in Q2. And the way we measure our business is really what is the ARPU per vehicle. And in Q2, it was 159 Rand. What is the time that a vehicle stays in our platform before a customer sells, or as an accident, or whatever, disposes of the vehicle, or we suspend service to the vehicle for whatever reason it might be. And that's approximately just over 60 months. And that gives us a revenue of a vehicle on the platform of about 9,560 Rand over the lifespan of those 60 months. You subtract from there the cost, which is about 2,300 Rand to onboard that vehicle, and you're left with 7,300 Rand. Then you have what it costs you to actually maintain a vehicle on a platform, and that's just under 60 Rand, what it costs us. So if you take the 60 Rand and you times it by 60 months, that you subtract the another 3,600 Rand, which will leave you with about 3,600 Rand operating profit. This might not tie up to your IFRS P&L, but it gives you exactly what your profit would be if you had to do cash accounting of 5 years in 1 year. It would give you the same result. And that there you can also work out what is really our operating profit margin. In South Africa, we grew by 14%. And we're starting to get momentum back in South Africa. I think the economy is starting to ease up a bit in terms of Eskom. I think the economy still remains under a huge amount of strain. But nevertheless, we're growing at 14%. I think we'll continue to improve that in the coming months and in the coming years. Asia, Middle East, which is predominantly Asia, we can just speak Asia, we grew by 26%. We're starting to get nice traction now in terms of our recruitment. We had a very difficult 2 years. Asia was largely closed down. It was not like South Africa. Actually, everybody was at home and all businesses were closed. The year post-COVID was equally as difficult because nobody wanted to work. Everybody wanted to stay at home. But now things are starting to normalize where everybody's coming back to the office. Europe, we grew by 14%, and we're also allocating quite a lot of capital to start growing Europe. And we're quite excited about the growth opportunities in Europe. Africa, we grew by 8%. It's not a real focus area, Africa, for us, but it's a very important part because it supports our South African customers that are doing logistics up into Africa or are going on tourism into the neighboring countries. This is our operating metrics. So our subscription revenue gross profit margin has consistently been in the early 70%. In Q2 it was 72%. Research and development as a percentage of subscription revenue is 6%. Sales and marketing as a percentage of subscription revenue is 14%. We certainly want to increase that. General and administration as a percentage of subscription revenue is 22%. Over time, that will decrease substantially, but we continue still in new geographies to really allocate money into opening new offices, getting bigger presence in other, including South Africa. We also increasing our G&A, but specifically in places like Europe and Southeast Asia, we're really starting to allocate a lot of capital there to grow our footprint. And our operating profit in Q2 was 29%. Adjusted EBITDA was 49%. Cartrack's outlook for FY24, we gave this outlook approximately 9 months ago. Actually, it might not even be 9 months ago, but we gave it out and we remain that. So we're expecting by end of November that we probably would have surpassed the 1.9 million vehicles already in November. I haven't looked at the latest numbers. We might have been past the 1.9 million vehicles already. So we're keeping the outlook for subscription revenue between 3.4 and 3.6 billion Rand. So we're expecting that. And the Cartrack's operating profit margin to be between 28 and 31%. We're well on track to meet our outlook for the year. I think over here, what we've got to focus on is Karooooo is, we've come into the end of that business, so we will not see that in FY25. And Karooooo Logistics, we're starting to drive our profitability. We did 8 million Rand operating profit on 72 million Rand revenue. That operating profit, if you look at that 8 over 72, is north of 10%. That might not be sustainable. So we expect that the operating profits will range between 5 and 12% while we continue to look to scale the business. Once the business reaches scale, we expect the business to be more at around 8% to be our operating profit. So I think if we can go into Q&A, if that's okay with you, Vanessa.
Thank you, Zach. That was a really great presentation, and it is fantastic to see a South African business operating so well in the global arena. So thank you very much for that update. It's amazing. We are now going to go into the Q&A session, which just as a reminder, facilitated by the Finance Ghost and Mark Tobin, and that you can pop your questions into the Q&A box at the bottom of your screen. Over to you guys.
Thank you so much, Vanessa. Thank you, Zach, for your time today. I've already got a couple of questions in my DMs, so people are itching to go, but I'm going to be cheeky and ask my question first because I'm a Karooooo shareholder. I should probably disclose that. So I guess my question is around Karooooo, which is something I've written publicly about before. So thanks for clarifying, I think, the reason for the exit. Part of me was hoping it was more because you didn't want to be in the business anymore rather than because you were under pressure from, other people in the industry to maybe exit it. So I guess for me, maybe some lessons learned from that foray into Karooooo, what would you say is your key takeout from that whole experience? And then genuinely asking as a shareholder, is the plan going forward now to kind of stick to your knitting, or are you looking to still do some ancillary stuff going forward?
Well, it's an interesting way, the way you put it, because I believe it was sticking to our knitting. And one could argue, but these are very old second-hand cars. But I think what we want to do as a business is really drive value for our customers, especially optimizing their assets, the value of the assets, getting them the best values for the best prices for their vehicles, or getting them actually the right vehicles. So over time, that will change, and I'm looking down 10, 15 years time, and we're starting to delve into what I believe the market will be like in 10 years time. So I think, coming from Singapore, what we're starting to see is less and less people own vehicles, and it's all about leasing and renting vehicles and optimizing the same vehicle being used by 3 or 4 customers. What we see, for instance, in Singapore, a vehicle doesn't sit for 4 hours doing nothing. It's actually being used in a bigger pool for other companies. We are, for instance, doing the same thing for the Singapore government, where they used to have vehicles that were for the police and vehicles that were for this ministry. We've now given them the platform where all the vehicles belong to the government and anybody can use them. And it saves a tremendous amount of costs. We also have the OEMs in China, for instance, talking to us about putting their vehicles to the right customers. So things will change, and we were starting to delve into that. But I think fundamentally, maybe one could argue that second-hand vehicles might have not been the right way, and I agree with that. But it was just positioning it for us for what could be in 10, 15 years' time. So I think the lessons learned, I think not many lessons we've learned. I think we cut our losses. We're not arrogant, because we weren't able to really put our muscle into it while we're having these side talks with all the dealerships. So fundamentally, there's a lot we're doing, but there's a lot, if you use the word stick to your knitting, is doing what we're currently doing. And a lot of the things that we're doing today that is really driving our success, none of our peers were doing it 5 years ago or 7 years ago, and they could have argued the same thing. And a lot of our success comes from things that we started doing 10 years ago. So just to give you an idea, we were the first company in South Africa to go into cloud. And, going to cloud could say, but, that's not your knitting, that's Amazon's knitting. We developed our own cloud in 2007. We went to Europe. We were the first company to be on cloud compared to our peers. So, yeah, without being arrogant in any way, there's always lessons learned, but I don't think it was a major lesson, but it was, we cut our losses, if that makes sense.
Zach, can I just jump in on this focus on the South African market for a second? Growth has remained robust in the South African market. I think it was 14% on the slide, which is, in an economy that's basically going sideways to slightly backwards. What would you consider is still and you dominate the South African market, I think it's fair to say, but what do you think is the total addressable market, or, the size of the opportunity still available to Karooooo in the South African market? Do you think, you're on the way to being kind of fully penetrated in here, or is there still, a kind of a big opportunity still to grow in South Africa?
So, Mark, South Africa has got, and the statistics are a little bit blurry, anything between 10 and 12.5 million vehicles. We've got on our platform in South Africa just over 1.4 million vehicles. We estimate there's about 3.5 million vehicles in South Africa installed. It could be as high as 4 million vehicles. We believe that we are very much focused on green market opportunity, although we do take business from our peers. And I certainly believe that we can triple our business in South Africa, given that we've only got, let's say 11 or 12% of the total addressable market in South Africa. So to eventually land with 33% or 35%, I don't think that's unrealistic. And we haven't really gone into a very competitive mode where we start trying to get our competitors' customers, because we certainly have got the margins to be able to do that, and we certainly have got the technology to do it as well. So, I certainly believe it wouldn't be too ambitious to say we can triple our business in South Africa.
Okay, great.
I've got a couple of questions in my DM, Zach, that have a similar theme. So I'm going to try and ask 3 questions in one and just sort of open the floor to you to talk about it. And I think for a lot of people, just trying to understand how Cartrack is a little bit differentiated maybe from some of your competitors, particularly in your overseas growth markets. I think as South Africans, we understand that a big part of buying a tracker is from a safety perspective. And I think a lot of people do get discounts on their insurance, recoveries of vehicles stolen, all that kind of thing. We all like to think that maybe overseas the crime rate is not so bad. So perhaps just helping people understand, what is the consumer buying decision in some of these overseas markets that makes them fit a tracker, and how does that differ to South Africa?
Well, not quite sure how to address you, whether it's Mr. Ghost or Mr. Finance Ghost. Okay.
Yeah, either of those, I'm sure is fine.
Anyway, thanks for the question. So outside South Africa, we only focus on commercial business. The South African market is a very unique market in which we operate in. And I think other markets similar to South Africa would be Latin America and Mexico, which is Central America. And from what I'm reading lately and what people in the inquiries we're getting, there seems to be a huge interest in the USA also for a lot of theft. In Southeast Asia and in Europe, there's hardly any theft. There's no market for theft. Also, the ambulance services in most of these countries work. I'm talking about the government institutions, it works. And so the market doesn't really exist for consumer. We could develop products to do that and to create that market. We haven't done that yet. We very much focus on commercial. So I'm not sure if that answers your question.
No, that helps a lot. If I can maybe be really cheeky then with a follow-up just to help people understand it. So how would your commercial offering then differ to some of your competitors? Is it kind of fighting for market share with a relatively similar offering? Is there something particularly unique to Karooooo? Because obviously a lot of it is just entering a new market. You get to win market share, and that's how you can get a very high growth rate for a long time. Or is there some kind of specific, very neat little competitive advantage that you think you have in some of those markets? And then I'll give back to Mark.
We certainly have got niche offerings in our platform, and our platform is very, very comprehensive. I would say just about every month we're either improving on things or adding new features, adding new stack onto our platform. It's forever evolving. Having said that, in the industry that we're in, even if you've got an edge over your competitor in terms of technology, I would say that in Europe and in South Africa, all our competitors are continuously looking at what we're doing. So even if you've got the edge, it's within 6 months, they're going to have it. They're going to copy you, or they're going to do something slightly different. So it really is just about continuously innovating rather than saying, I've got this feature, this differentiates us. Because if it does differentiate you, it's not going to differentiate you for very long. So it's just the continuous innovation, the continuous being customer-centric, the continuously being value proposition, the continuously being honest with your customers and really not rely more on economies of scale to give them a great pricing, and keeping the culture of the company right. And, we really are good at retaining our customers. We have very little loss of our customers. We lose very little customers. And I think that's key to our growth. So if you look at our platform, the way it works, it's so easy to use. I mean, it looks easy to make, but it's actually quite difficult to replicate. So if that answers you. It's just driving a lot of value for as little as possible to the customer, little cost as possible to the customer, and being totally focused on customer acquisition and growth.
Zach, it's Mark here again. Maybe just a quick one. From what you know, does somebody, I think this is more relevant to the South African market, get a discount on their insurance if they have one of the Karooooo trackers installed? From my understanding, that's correct. Am I right in saying that by and large people would be kind of getting discounted insurance by having a tracker fitted?
So that's not our case, but that is certainly the South African scenario. So what you do find in South Africa, most insurance companies, they will give you a discount if you have a tracking device, or they might not even insure you if you don't have a tracking device. These are large deals that are done by the well-established South African insurance companies. We don't like to play in that role, so because normally it's either the commissions or the revenue per user and the stickiness of the customer. As you well know, the consumer's affordability is not great, so they're continuously shopping and moving from OUTsurance to budget, and from budget to king price, and there is you can't get your 60 months out of a consumer. You're paying much lower. The insurance company is paying you much lower ARPUs. And the unit economics don't work for us. So our model is very different. Most our consumer customers come directly to us. We've got a very strong brand. We've got a very strong value proposition. Our service is well known. And the insurance companies that do send the business to us are for their high-risk vehicles. So their mass market, they give it to our peers, and their high-risk vehicles, they give it to us.
Okay, and then just another quick one. You mentioned kind of South America, and there's a question here on, why you're not kind of operating in South America and Mexico, and where there's also large markets, consumer and commercial. Maybe just talk to us about the expansion outside of South Africa. I know you mentioned it in your remarks with the slides. The move to Singapore to tap the kind of Southeast Asia market is. Maybe talk to why you didn't look at South America versus, Southeast Asia, given those huge populations in both regions. What was more attractive about the Southeast Asia opportunity?
So with all these things, it's always very difficult to decide which market you want to go to. And one could go to Southeast Asia, you could go to Latin America. I did go and look at Latin America. And so Latin America's got a lot of characteristics more similar to North America. And what I've learned in doing business, it's the South African mindset is very unique. It's very different to anywhere else in the world. Probably the most similar mindset to South African mindset are the Europeans. Once you go to the Americas or you go to Asia, they're very, very different mindset. And for that, you'd need to take very senior people to go live in the States or in Latin America if you want to be successful. I then looked at Southeast Asia. I like the market. I believe very long term, Asia will be the fast growing GDP per capita, and it will have a huge emerging markets that will become first world markets over the next 25 years. So I believe South Asia over South America. And it was on that basis that I then decided I personally live in Singapore. And I just think for a very long term and for future generations, we'll build a better business in Asia. Having said that, if we one day needed to consolidate the business, we'd obviously find somebody that's very strong in Latin America and in North America and consolidate with them. But I think you can't go to these markets and run them remote control. And if that answers your question.
Yep, that does. Thank you.
I've got a couple of questions just talking to margin, I suppose. If we kind of look at the growth in subscription revenue and then how some of the expenses are working with that, like admin expenses seem to be becoming a bit more efficient over time, but R&D and selling expenses, those seem to grow with revenue. So just a couple of points around maybe, where does sustainable margin sit? Like, can it expand from here? Or is it just a case of kind of growing profits in line with revenue? I suppose that's one part of the question. And the other part is just in Karooooo Logistics, which a business you are carrying on with. Also a similar margin type question. What does steady state margin look like there? You seem to have reached an inflection point in profitability, which is great to see. It's now gone firmly green. So what do you think that margin eventually looks like?
Okay, so I think the margin will eventually be between 5 and 10% once the business is more mature. That margin can still come down. So we're very much focused on South Africa, getting our models right before we take that part of the business into Europe and into Southeast Asia. And obviously, as you expand, those margins come down. But I think at maturity, the business should be between 5 and 10%. The reason our margins were well above 10% in this quarter was because we sort of slowed down investment because we just needed to fix a few nuts and bolts. We've always grown our businesses very much organically, where our capital allocation and discipline is important to us. So that's the reason we got such good margins. So 5 to 10%. On talking about Cartrack, our margins at this point in time, like I said earlier, there's our IFRS margins. So the quicker we grow, the more capital we allocate. And when I say grow, I'm not just talking subscribers, I'm talking about subscription revenue, ARR. And then obviously that can have a negative impact on the IFRS operating profit margin. But as management, I don't look at IFRS, I don't look at that income statement, I look at the unit economics, because that takes out all the different IFRS rules that continuously change to entertain accountants. And we believe our profits are actually north of 30%, and they certainly are sustainable, provided we don't get into a price war, which we could do at some time. Well, I don't think to do it now to be premature. And then, the operating profits could come down, but we've got a lot of ability to up our revenue per subscriber, because our revenue per subscriber today is the same as it was 15 years ago, and we just relied on economies of scale. As we add more stack onto our platform and more features, we can certainly upsell customers, something we currently don't do. So there's definitely, we've got operating profit margin to compete, and we've also got the ability to increase our ARPU. So I feel quite robust that our financial model is sustainable to keep these sort of operating profit margins.
And Zach, it's Mark here again. Yeah, I just want to talk maybe about pricing power inherent that you have. I mean, just given, you talked about the ROI and, how quickly, you can get payback from an investment to find, a logistics business with, a fleet of 300 or 400 vehicles, and, I'm going to kind of get my money back very, very quickly, definitely within the first year. So in terms of, when these people come to renew, where does pricing of the core offerings start to factor in? I think of, the last 18 months in our own business, the amount of price increases we've got through from a lot of our tech providers has been, you know, very noticeable, that they're now pushing up prices, whereas before it seemed kind of, yeah, that's reasonable. Now you're kind of second guessing it. But in terms of your business, you know, where is pricing of the kind of core thing? You say, you know, you haven't really adjusted the price in maybe 15 years, but, you know, does that some inflation plus kind of increases come in, and is that on a kind of annual basis that you'd be thinking of upping it?
So if you look at our prices, like I said, you know, we've maintained them for 15 years, but our cost to operate the business, it's getting lower. So in other words, it's just the economies of scale. So if you look at our operating profit margins, it's reflected there. So we just become extremely more efficient. You know, it's even the way we work, the way we run our business, our internal systems. So once we see the operating profits, inflation doesn't allow us, then we'll look at pricing. But at the meantime, we probably can increase prices, but there's no need to. You know, we've got great operating profits. You know, we can start being greedy and starting to make more money. We don't need to. Let's just focus on growing our customer base. So we've been able to weather all this inflation through economies of scale. Where the problem comes in is when the business is not growing. And now the only way that you can actually sustain your growth is by increasing prices, or even to sustain your margins. Then obviously that will be a very different scenario. We're not there. We're quite fortunate that our business and our efficiencies just continue to increase. So the same way as we look at, you know, increasing the efficiencies of our customers, we also have a whole part of our R&D that are totally focused on increasing our own internal efficiencies.
Okay. I think the one theme that's still in my DMs is around churn. And I guess that's a key input into your average revenue per user, or your profitability per user, specifically the lifetime value of a customer, right? Or maybe some of the costs as well. So I think just churn trends, I mean, what have those sort of been, especially in this environment of difficult consumer affordability? Do you find people hang on to their tracking? And I'm sure something like, you know, for example, the discount on insurance helps subsidize some of that. It was interesting to see Suntum's numbers this week and the significant inflation in short-term insurance. So insurance costs are becoming a bigger and bigger hassle for South Africans. So I guess just understanding a little bit about churn, and then do you have any insights on where those customers go? Is it a matter of going to a competitor, or are they just canceling for affordability?
So I think there's two parts that I just want to speak about, because often this is not understood. So there's one thing called customer churn, and I'll talk about our customer churn. We lose about 5% of our customers per year. Of those 5% of the customers that we lose, so in Europe, we lose about 1.5% of our customers per year. In Asia and in South Africa, we lose about 5%. Our average is still 5%, given the size of South Africa and Asia in the bigger scheme of things. Of those, 80% of those customers we lose, it's because we've switched them off because of affordability. So it's consumers that can't afford it, or it's businesses that have actually run out of steam. And they close down. In Europe, very few businesses actually fail, and that has got to do a lot with the mindset of Europeans. You know, average European just wants a good job. Average Asian wants to start a business, and average South African wants to start a business. So there's more failure rates, and that leads to the higher churn. And about 1% of the churn is actually customers not being happy with us. Now, they would probably go to our competitors. So we probably lose between 1 and 1.5% of our customers to our peers every year. Then you've got the adding the assets or the vehicles to your platform, and that's where the life cycle comes of 60 months. That is really people, our customers, they buy fleets and they sell fleets, and every time they sell their vehicles, or they write vehicles off, or whatever they do, that vehicle comes off our cloud. And that is churn of vehicles which is really something we cannot control, because it's ultimately the customer that decides when are they selling their vehicles and when are they purchasing new vehicles. And that churn can range anything between 16 to 20% per year. During COVID, that churn was much lower because people weren't buying and selling cars. They were keeping their vehicles much longer. What we're now seeing in South Africa is that is also tending to drop, where people are also keeping their vehicles much longer. And we've also got very good data to know what type of vehicles are kept longer, which customers keep vehicles longer, and we can sort of predict this in our budgets, given the type of customers, the type of vehicles, and the geographies we operate allows us to do this quite effectively in our budget planning.
Just on, you mentioned competition and peers there. In terms of when you're going into these new markets, whether it's the US, Europe, Southeast Asia, where you are in Singapore, I mean, who are you kind of coming up against? Just to give people a flavor of, some of the peers in the industry, if they kind of want to do a bit of a deep dive on this whole sector or industry as a whole, and to kind of see where Karooooo sits versus some of the other players.
So I'll start in South Africa. So South Africa, we've got Cartrack, we've got Mixed Telematics, we got Netstar, and we've got Tracker. I think between the five of us as companies, we probably own 95% of the South African market. Then there will be, I estimate there's another 200 tracking companies in South Africa. They come and go, they start up, they leave, so there's probably in South Africa, I would say in the region of between 150 and 200 companies. And I would say that the five companies, in which we are one of the five, we probably own 95% of the market. In Europe, there's a huge amount of consolidation. So today in Europe, our biggest competitors are Verizon, Michelin Tires, Continental, and Bridgestone. And they've basically have bought up as many tracking companies as possible and put it under one umbrella. We have been approached also to be acquired by these companies as well. And that sort of concentrated the market, and we come up against them. And I would say that on most times when we come up against them, we win the business. In Asia, it's very, very fragmented. What we've seen is a lot of companies from America, from Europe, from South Africa come into Asia and not make it. Asia is very, very different to South Africa, and there the market is super, super fragmented, and there's no single player that is meaningful in size. In America, we don't play in that market. We have got 1,500 trucks and without technology being used in America, we've got a very small office in LA. We've got 3 staff members. We're not expanding that business because we realize we will not be good at it running its remote control, and we've got enough on our plate. And obviously in America, there's the American competitors that are well known, but it's not our focus area, and there we just really get value for what's happening in America, so that we also are conscious of the developments in the American market.
I think there might be time for literally one last question, Zach, but it's going to be like a 1-minute answer. And it was a question that I got in my DMs early on in the process, just around the extent to which you can use or think about using debt on your balance sheet. Obviously, it's a very cash generative model, but you do have quite a lot of net working capital investment in terms of telematics devices. So the question is just around the way you think about sort of longer term debt on your balance sheet. And if we could just spend a minute on that, and then I think we are done.
I think if we had to go into debt, it would be because we've got a sizable opportunity for M&A. We would be very cautious to do any M&A. But if something good comes our way, I think we can certainly tap into debt. We've got a 1 billion rand unused facility in South Africa. I've got the Singapore banks continuously seeing me, wanting to give me $200, $300 million for acquisitions. They're continuously bringing me opportunities, but at the same time, we want to stay focused and we want to grow organically. And we haven't seen any real opportunity, that we want to grab immediately, if that makes any sense. And we've also got cash. So we've got cash. Our balance sheet is very good. It's very solid. And we have got the flexibility to get debt should we need it.
Great. Thank you very much, Zach, the finance ghost. Mark, that brings us to the end of the session with Karooooo. And just to once again say thank you to Zach and Lauren for making this time to support this platform and also to engage with potential investors and current shareholders. We hope that you've enjoyed this event, and if you want to listen to it again, it will be on the Unlock the Stock YouTube channel. And we would also obviously hope and encourage you to just please subscribe to that. This is the first time in Unlock the Stock's history where we're going straight into another session with TWK at literally 2 or 3 minutes time. So when that session is over, the next session of Unlock the Stock will also take place on Thursday the 23rd, which will feature Lasaka Technologies, and that's going to then close off Unlock the Stock for 2023. So thank you everyone for participating, and goodbye.